Good morning and welcome to the EMV CAPITAL PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. And then I'd like to hand you over to Ilyan Ilyev, CEO. Good morning, sir.
Good morning, and thank you all for joining us for the presentation of our annual results for 2024. I'm Ilyan Ilyev, the CEO of EMV CAPITAL PLC, and I'm joined by Ed Hooper, Executive Director at EMV CAPITAL PLC and General Counsel. So there's a lot to go through this morning, and I just want to flag the presentation will be available on our website and, of course, on IMC after this call. So if you don't manage to pick up everything, you'll be able to refer to it. But look, I mean, as you know, it's been a complex year in the markets, and we have some exciting and interesting updates at the EMV CAPITAL level. But before I get into those, for those of you who have had less exposure to our story, I want to remind you of what we're about. For the last few years, we've been building up a vision to be a leading VC investment group in the deep tech and life sciences sector, primarily focused on the UK with some international exposure. We're focused on companies that are IP intensive, that are real, that have real impact in the world. And as you'll see in the next slides, we have, over the last few years, built up AUM of roughly 100 million, of which 38 million is on balance sheet. We now have a relatively large portfolio of 70 plus companies, and we're quite ambitious. We're now driving towards the next milestone in our journey of 200 million assets under management. Last year, we got our direct FCA authorization, which enabled us to launch the fund management practice. And I guess, again, you'll hear a lot more about each of these aspects shortly. A little bit about our model. So while we are a VC, we are also focused on generating fees on an ongoing basis. We live in a complex world. We believe that the old model of doing venture capital is changing. And the way we have developed the business over the last few years is we have recurring fees from fund management. We also have corporate finance fundraising fees through our FCA authorized subsidiary. And we also have a value creation services business, which again generates fees. This is to help us pay our way through life. Ultimately, what makes things exciting is the exits and carried interest we get from the portfolio as companies mature and exit. So within our model, these several blocks provide us with something that we think is somewhat unique in this space. The corporate finance side of the business enables us to facilitate and syndicate external investment for our portfolio companies, which in turn enables the companies to execute their growth plans. The value creation services side helps not all companies, but a cohort of companies who find themselves at a pivot or at a changing situation for us to provide some resources so that they can move to the next. It can be helping them with investment and exit readiness. It can be helping them evolve or pivot their business and financial strategy. It can be us helping them to build or rebuild their leadership teams. But the combination of the money and the value creation services we found is quite a strong combination. I'll talk a bit later about our venture building practice that combines these two functions that has led to significant fair value growth over the last few years. At any rate, across all of these companies, whether we are engaged in this or not, we have a proactive approach where we engage with the company's boards and their co-investors, protecting value and driving returns. And as I flagged earlier, ultimately, this is around realizing capital returns and carried interest returns as the companies go towards exit. A little bit about the growth in assets under management. So this has multiple benefits for the business. Of course, it scales our recurring management fees. It increases the potential for the carried interest, but also it helps us increase our firepower for the existing portfolio and new additions that we might have in the future. Now, there's several components of our AUM growth. And again, through the next slides, you'll see what that translates into numbers. There is the EMV Capital balance sheet investments themselves. Now, we tend to use cash very sparingly, but we use services as a way of building up our position and sometimes cash. We have a naturally growing third-party managed side of the business through an ever-growing investor syndicate. And I know some of you are on this call. We want to thank you for your continued support. That has a natural growth rate. We raise in the order of 8 to 10 million a year from that side of the business. We also added the Cambridge-based Matlet Capital Fund last year, May. So that in itself has grown our business, but there are some initiatives around that. We have also taken over the management of our EAS fund, which again has growth potential through IFAs and wealth managers, and there are other fund initiatives that we're developing. So what I want to emphasize here, it's not one shot on goal, it's multiple shots on goal for us to grow our AUM to that 200 million mark I flagged earlier. Now, in today's environment, there have been a lot of speculation in the market about where AIM is going and where the companies on AIM are going, and you've seen some of them where they went. Naturally, like any other business, important and sometimes hard discussions at board level. Where we stand is actually, we feel for us as a VC, actually being on AIM is a differentiator and an advantage. So over the last year, we have made, given the circumstances, we feel quite productive use of our quotation. In December last year, we had a 1.5 million placement at the 15% premium. And again, I want to thank those of you on that. We really appreciate your support. But we've also used our shares smartly, we think, to anchor an investment round in Qbot, which has been undergoing a transition. We did that at a premium. We've been able to issue shares to suppliers or strategic parties, keeping the cash on the balance sheet secure, but still engaging those people and aligning them with our own interests. But what we've also found is talking to both UK and non-UK institutional, corporate, or family office investors is that being on AIM, being audited, and of course being FCA authorized gives us an institutional grade feel and the transparency of the governance to other investors in our fund structure, in EMV Capital itself, of course, but other partners we're building in. So we feel that will continue to be important for us. Last but not least, it provides management team incentivization. Having said all of that, the market remains tough, the market remains with challenges, but we believe that we are well positioned to benefit from the various Mansion House initiatives, both at PLC and fund management level. What we do is exactly what Mansion House says UK PLCs and UK VCs should be doing, backing UK industrial capabilities. Our shareholder base is loyal, I would say. There's been several shareholders that have increased their exposure over the last year. And the directors and PDMRs hold a relatively significant 17% of the business. I won't speak too much here about the portfolio. I've got a few case studies later on. But what I'll flag is that with our portfolio has been remarkably resilient over the last few years in terms of portfolio survival and growth rate. Again, this is a function of our proactive approach. And with the Matlet Capital portfolio, we now have exposure both to the ecosystem and the specific assets of some of the UK's best VC-backed companies. Companies such as Cambridge Gun Devices, Ekion, New Quantum, Paragraph, and others. These are some of the best of what the UK has to offer. And accordingly, both our traditional portfolio and the EMV Capital portfolio have attracted significant third-party funding. 105 million from our legacy portfolio, and the Matlet Capital portfolio has attracted 171 million. So across both of those, this is more than $250 million that has been attracted by our portfolio. It wasn't all us, we did a small part of that, but I think what it shows is that while the VC markets have been really challenged, we happen to be operating in a part of the market that is active, that with investors that is seeing market growth. So that's the high level picture, but let's get into the numbers. So look, we've had a diverse but ultimately successful year. Group revenues have increased by 70% to 2.5 million from 1.4 million last year. But within our model, because of the way we account, we differentiate between what we call as the core. So that's PLC, EMV Capital Partners, which is the FCA authorized part, and other operating parts of the company. This is where the business is. And the number is companies the way we happen to be accounted as subsidiaries, but those companies are funded by other investors. So we consolidate the losses and the revenues, but from a balance sheet perspective, what we focus on is on the core. So in terms of the core, we've had 67% increase in the core revenues to 2 million from 1.2 million last year. That is covering roughly 58% of the core costs. And turning to the losses, the loss of the core has increased slightly to 1.5 million from 1.1 million. That's partly accounted for the consolidation of the Matlet Capital management side of the business, a lot of which is now set and pretty synergistic. And the other losses are accounted for by the subsidiaries. And again, I emphasize that the subsidiaries, Proaxis, Glycotest, are almost entirely funded by third-party investment, so it's not a burden on the balance sheet. Now, if you take a deep dive within the group revenue, you will see this steady growth in our revenues since management team took over in 2020. If you recall, what was then called Net Scientific PLC acquired EMV Capital, which is the company I led, and we brought with us our management approach. And since then, we've seen a good trend in terms of the revenues generated in the business. This is split roughly 3 ways between fund management, fundraising fees, and services. And we believe there is a scope for growth from each of these channels in their own different ways. I talked about how we plan to grow our AUM business, so that's how fees will grow there. The corporate finance fees, look, we've syndicated 8.6 million pounds of fresh cash into our businesses. This is money that goes under our custodian with carried interest exposure, which is higher than the previous year. Remember, this is in the middle of a bear market. We're in a very challenging market. So we believe that if, as the markets improve, there is significant upside for the corporate finance side of our business. And of course, there's the recurring value creation services from the portfolio, which has scope for growth. Now, if you look at the fair value growth of the direct holdings, this is what we hold on balance sheet. And over the last few years, you can see that this has had a steady growth. What has happened if you compare the high in 2022 versus 24 is in 2024 to 22, PDS Biotech, our Nasdaq holding, had a particularly good year and they had a very high valuation. But since then, the portfolio has balanced out, whereby the privately held portfolio, i.e. not listed companies, has grown significantly. Through this period, we have deepened our stakes and we have added some new holdings in new companies in that space. So we think that now, compared to a few years ago, this is a much more diversified and therefore stable direct fair value with significant scope for growth. This will naturally grow simply because the companies are growing in value. Not all of them, but the majority of them have grown in the last year. We also find that opportunities to deepen our stakes on favorable terms as the companies normalize the fair. Finally, we anticipate adding new companies with direct balance sheet exposure. Now, turning to the managed assets under management, this is where the fund management practice is. That again has grown quite significantly, 43% CAGR since the end of 2020, the acquisition of EMV Capital in that year. So again, here we expect a natural growth in our AUM. Of course, there's volatility, but the managed companies, the ES fund practice is growing organically at the rate of 8 to 10 million pounds a year. And finally, we're looking at new fund launches to continue to drive AUM. So both measures of fair value, direct and managed, we anticipate will continue to grow simply because of the model we have set up that has its own momentum. In terms of fair value composition, you'll see here the direct assets are 37 million. The balance is managed. Matlet Capital naturally represents a significant part of that. And we anticipate the ES fund will accelerate growth as IFAs and wealth managers become on-ramped onto it. In terms of the specific companies, again, if you looked at this pie 2 years ago or earlier, there was a lot of concentration on 1 or 2 assets. And I'm just flagging here that it's quite diverse right now. Now, this is an important analysis. Our current market cap is around 12.2 million at 47p per share. For our NAV, we are not the accounting measures do not include the value of the subsidiaries due to direct consolidation, and in the annual accounts that is explained. So what we've done this year is we have done an adjusted NAV to show you if we were to account, or once you do account for the subsidiary companies, what happens to the adjusted NAV and what happens to the adjusted NAV per share. And we've also then looked at the direct fair value, what the direct fair value per share is. So what you can see is that even on these static measures, there is significant value simply not captured in the current NAV per share, and the gap between the two is really quite substantial. We believe as management that even that is somewhat of an understatement because it does not capture the embedded goodwill within the operating businesses. We're generating recurring revenues from fund management fees and value creation services. If it were a different business, that would have value in itself. There's the future carried interest from fund performance. And of course, there is the expected growth in the underlying portfolio. Now, we're using BVCA methods. I know there's some questions on our methodology. That's naturally historically looking. It's what has happened so far. So these measures do not include what might happen in the future, which could be negative and positive, of course, but we're management, so we're optimistic. So we believe quite strongly that as a result, the current market capitalization is significantly underestimating the group's real value. And of course, we want to communicate this gap or this believed gap better with the market. I've talked a lot about the Martlet Capital mandate we acquired last year. Again, this didn't come out of nowhere. We have been close to the Martlet Capital team and investors for many years. Before that, we played a role when that was spun out from Marshall Aerospace, from Marshall Group. But last year, we took over as fund managers, as you know, and that has provided, it was a paper transaction. It was very effective, capital efficient for EMV Capital shareholders. It has provided us with this additional AUM. I also talked about the portfolio of companies that this has provided us and the multiple shots on goals we have that. But over the last year, we have worked closely with the team at Martlet, who are now fully integrated in EMV Capital, and building out our exposure to the Cambridge and international ecosystem around the Cambridge High Tech network. Another effect, for those of you who know the place, is that we have shortened the height of King's College Cathedral. That's a bit of image manipulation there. But in terms of on a go-forward basis, we're looking at continued AUM growth of that asset, but also the opportunities that come out of Martlet Capital's co-investment for our ES practice and the potential for raising a new fund. Just under a month ago, we led an additional investment into Martlet Capital, giving it a bit of more working capital and dry powder. And again, we're continuing to grow in this space. Now, I talked about our venture build practice. I'm going to spend a little bit of time explaining what we do here. As a PLC, rather than a plain vanilla VC fund, we have multiple tools we can use. We can use PLC balance sheet, we can use paper, we're able to anchor investment rounds, we're able to have a service side that's not part of the fund management. And we have used this multifaceted strategy to engage with a cohort of companies, which you'll see in the next slide, to go in when the valuation was at an attractive position. The companies had certain issues to be resolved. And we use the combination of our corporate finance side and value creation services side to help those companies pivot, clean up their model, attract funding to them, and crystallize value. We're going to continue to do that. So we're targeting companies that are IP rich with somewhat validated IP, perhaps not in high revenues, but visibility towards that, who need this strategic redirection. We restructure those companies. It can be a cleanup of the cap table. It can be us providing cash in kind, but we get direct exposure to the equity there. And we then help them grow. Using that model, this is over the last, within the last 3 years, basically, we have invested £400,000 in cash, about $500,000 of in-kind services, and we have generated 8.5 million of fair value. Now, admittedly, this is paper. We haven't had exits. The ultimate proof is the exits. Nevertheless, this is fair value validated by third-party investment. And we feel that's quite a unique story, something we're able to do. And the reason we're able to do it is because of everything else that we do. It gives us all these different tools. It's a very capital-efficient model with strong embedded upside, and we'll continue to do it selectively with various companies. In terms of the businesses, this includes deep tech recycling, plastic waste, chemical plastic waste recycling that I've talked about before, D-name it, in the lab space, Ventive, heat pump developer, Vortex, liquid biopsy, Wonder Health. Now, we've had some exposure to some of these companies for a while. What we're talking about here is when we gained the direct exposure, 21% deep tech, 30% D-name it, Ventive 10%, Vortex 22%, Wonder 21%. And you can see for some of those companies we've been monitoring for a while, and we found the right place to gain exposure, which was within the last 3 years. So we feel quite positive about this story. It's not once, it's not twice, 5 times we've done it with 5 different companies, and we're going to do more of the same. What's also worth flagging in the next few slides is that the combined direct fair value of these companies exceeds our current market cap, which again is a different way of looking at the gap between current market cap and the underlying value of EMV Capital. I've spoken about each of these companies in previous presentations, so here I'll just focus on the developments over the last year and 6 months. So Sofan Technologies, which is an Edinburgh spin-out, over the last 18 months, they have advanced their collaboration with Viasat. The space itself is really exciting, perhaps for the wrong reasons. The war in Ukraine has shown the importance of drone and aeroborne platforms, but also just in general, SATCOMs as a part of the mainstream telecommunication systems has really had a breakthrough. As a result, the company is experiencing a lot of external interest. They've done a successful test of their antenna, that it can talk to space, but also we've attracted investment from the National Strategic Security and Investment Fund and a US family office. Final assembly is expected later this year with revenues in next year. So this company has really interesting prospects this year. Wonder Health was a company that we incubated for a few years. Last year, we got direct equity exposure. And in particular, from the second half of last year, they've had an acceleration of recurring revenue growth from several US customers. These are US healthcare insurance, online pharmacy players. And the guys are having a really exciting time right now, just really handling growth with the US market. And this is also a fascinating story, how you can run a company on a lean budget from the UK accessing the US market. Deep Tech Recycling, they built a pipeline of projects over the last 2 years, and now those are paying dividends. Sorry, not in financial sense, we're seeing results. We've had a MOU for a project in Scandinavia. There's been now a term sheet provided from a Scandinavian public sector authority for up to £11 million for their first plant. Now remember, this is off balance sheet. Deep Tech sets up SPVs to build plants for plastic recycling. There's a lot of depth about each of these. There's more information in the annual report, but I'm just giving you some highlights here. So for each of these companies, if you look at their market cap, there is significant growth potential as the companies get through to sales, get through to break even, get through to first project. It hasn't been all smooth sailing. Another 3 companies, Proaxis, Glycotest, Qbot, have had challenges to overcome over the last 18 months. Proaxis actually had a very good last year with significant growth in revenues. They cut a lot of costs, but they've had a production issue that emerged towards the end of last year, which has meant that they've had to pause the fundraise that we were planning on, and they're working to resolve that issue. At the same time, they have built a potential clinical trial launch with Imperial College, which we anticipate will launch later in the year. This is focused on COPD. So again, the companies naturally in this space, they have issues, they find problems. Where relevant, we work with them and help them work through those problems, get to the next stage, and then they resume their growth. Glycotest has had actually good progress in terms of moving their validation assay through a mass spec, what's known as mass spectrometry validation platform. But the US life sciences markets are quite challenging, so there's been an ongoing fundraising round that's slower than we want, and they need to close that off to accelerate growth, to accelerate the market launch. So in terms of what they need to do, we're quite clear. It's around closing off the fundraising round to get them to the next stage. Now, Qbot has been particularly challenging. It's a company we really believe in, with an excellent technology, with more than 5,000 successful retrofit installations, using their robots to do retrofit installations in the UK and France. Really massive market. The company last year decided to make a pivot away from a services model where they had a fairly large employment force doing direct installations towards an IP and partnership and licensing model. It was a difficult turnaround. It was a difficult pivot, which has seen the valuation of the company go down. We have played a key role in that pivot and bringing investors onto it. So we believe the company is turning a corner now at a much lower base. We've cut 70% costs there. significant drop in the workforce, and now the company is turning a corner. So what I want to flag here is that when companies have a problem, when they get into trouble, when there is a challenge, we don't say, well, look, we've got 70 companies, we'll let these ones go. No, if we believe in the company, we engage, we help fix the problem, and then we benefit from that. And we believe our co-investors have seen us do this several times, so there's a growing confidence in our approach. So what's forward? Well, first of all, we've had a very busy first half of the year. There have been multiple fundraisings, as you can see. Now, some of you ask on the forums, yes, I do read the forums, publicize these investments, why don't you talk about them? Look, we're a PLC. We have very strict rules about what is an RNS and what isn't an RNS. So we would rather be purist when we put out an RNS that it needs to fit the criteria, because otherwise, where do you draw the boundaries? Through LinkedIn, you can see all of these developments. But what I want to flag is that while there isn't that much in the RNS, there is a lot of activity ongoing underneath with the businesses. So there's been a lot of fundraising work. I wish I could tell it's all success. The reality is that in today's market environment, the the rounds are smaller, it takes longer to develop them, and the investor terms are harsher. That is the reality. However, equally in that environment, many companies outside of our portfolio haven't been funded at all. So the way we have approached the current environment is, look, guys, you got to bring in the sales, cut back your business plan, have more modest objectives. Let's get funding to get you to that next stage. You'll be then at a better position, and then we'll take it from there. So again, without going into the details of here, each of these companies has its own story. We have helped them work through their funding issues and get to the next stage and develop. Some of them have really accelerated, like Wonder. Others are still solving issues. Deep Tech also is accelerating. Others, such as Qbot, are working through their issues. But again, we're there as a supportive partner, helping the companies through to the next stage. More broadly, where do we see? Well, I mean, it's what we said for the last 2 years that we have been implementing. We have grown the assets under management. We believe it will continue to grow simply through organic growth, but also through the new fund launches that we have mentioned and expansion of the ES practice. We have revenue momentum that we want to exploit. We continue to target break-even at the core group level, which for us will be a very meaningful milestone. At that point, we become financially independent. We recognize that the market environment is challenging. We did attempt to have one exit, and we saw that the market is just not there at the moment. So instead of that, we're focusing strategically on the companies moving through the value inflection points, selective growth, and of course, building links with potential acquirers so that when the time is right, the time is right. We believe we're quite well positioned over the last, with the progress over the last 2 years for any potential market recovery. We believe that the markets we're in, deep tech and life sciences, have strong tailwinds. It is places people want to invest in. And in particular, we're well positioned to benefit from Mansion House reforms and all the related changes around that are developing. So we know it's not all smooth sailing, but at the same time, we're resilient. What I think we have demonstrated to you over the last few years is that we can navigate challenging times well. We have a resilient model. We have multiple shots on goal, and we have multiple avenues for value creation. So I think with that, I'm going to finish off again, on the summary slide. Many drivers for value, but now I look forward to hearing from your questions.
Ilya and Ed, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via Investor Dashboard. As you can see, we received a number of questions throughout today's presentation. Can I please ask you to read out the questions and give response where appropriate to do so, and I'll pick up from you at the end.
Okay. All right, thank you. So there's a few questions that I think I've covered well during the presentation. One is, could you talk a bit more about your plans to raise further AUM? Is there anything imminent? So again, I want to emphasize, I often talk about a group of MBAs running around with a business plan and we're raising a fund. We're not that. We have an ongoing business that organically is growing its AUM anyway. Through our ES investment practice, we organically grow by at the rate of 8 to 10 million pounds of fresh cash per annum, and our companies are growing. So we're not standing still, even if a new fund isn't raised. Having said that, in parallel, we have several initiatives around a new fund. It's a challenging environment to raise a fund. We're not blind, but equally we feel we have something special. In terms of, is there anything imminent? It's nothing that will crystallize in the next few months. It's a sprint or a moderate run. It's not a 400 meters. Perhaps it's a 1600 meters, not a 40 kilometer. There were two questions around exits. If and when there is an exit, how would you deploy the capital, and what can shareholders expect? So, and maybe if I turn to you for that one.
Yeah, thanks, Cillian. So as we've published, our strategy follows a evergreen model, which means that we want to continue on the journey. So in the event of an exit, I guess we've got a number of considerations to run through. Look, part of that is reinvestment into our venture build program, where we see great returns coming through, as Cillian's referred to earlier. In order to launch new fund initiatives, there's often a GP stake that's required. So we have purposes for any exit and upside income. Obviously, the shareholders will be keen to understand whether there's any returns coming their way. I wouldn't put us perhaps as an income stock. We're a capital growth business, but I think we certainly haven't ruled out any capital returns in the form of dividends, buybacks, etc. And it really depends, obviously, upon the size and timing of exits. So I hope that gives a bit of guidance that we're flexible with no fixed policy on that. I think there's another question also in terms of visibility on exits and what's on the horizon. Ilham referred to Proaxis, which we had a look at selling last year. That as we published earlier, the feedback from that exercise was actually very positive in the sense that it gave Proaxis a great deal of inside feedback on how to grow and be more attractive to the buyers that it was talking to. Right now, the M&A market, in our view, in this space is pretty slow. Valuations are not what we would expect them to be. And I think our evergreen model puts us in a very good position there. We're fortunate that we don't have a fund that we need to close up at any particular time frame. And we're not looking at continuation funds and all of the other things that some of our peers are looking at. So we've got the flexibility to hold until the right valuation comes about. We're not just waiting. We're proactive investors. We're proactive managers for all of our key cohort of companies where they're in a venture build or value creation services program. We have a M&A readiness project for them, so that as and when the markets revive, as and when they pass through key and value inflection points, they're ready to go. They're not starting from a cold start, but they're ready to go. As and when a buyer approaches any one of these people, they've got a data room ready to go, and they're ready to launch quickly and take full advantage of the scenario. So I think that hopefully gives you a bit of guidance on our M&A policy and returns policy.
Thank you, Ed. And a question from Richard: with over 70 companies now under management, how do you approach portfolio concentration risk? Well, I mean, naturally, with more companies, there's less concentration. I think the way we look at it is because we're not a passive investor, there's different ways of mitigating portfolio risk. There's just a natural static risk mitigation because there's more shots on goal. So, even companies where we have a small percentage, let's say someone like Cytovale, that we have very little day-to-day involvement, but we have an exposure to it. And last year they raised 120 million, and it's a well-known company in the US. So, if there's a big exit there, we'll get some returns. So that's what most VCs look at. Here is our passive portfolio. Let's see and pray when something comes in. I think the way we see it is, look, there's a passive portfolio diversification, which is nice. But because we have this proactive approach, we're also able to proactively deepen our stakes in companies that we like. Sometimes these are companies that are simply doing well, and we bring in some third-party investment into that. And again, being part, the integration with the Martlet practice gives us a lot more opportunities for that. We anticipate our ERS practice will benefit from that, this greater diversity. And some of the feedback we've had from our ERS investors, both direct and through our ERS fund structure, is, oh, that's great, because within a portfolio, I get exposure both to the direct venture build, where I'm taking a bet on your capability of building businesses, and within the same portfolio, I can also get a kind of exposure or bet to companies where you're sitting alongside other bigger investors in the companies at the next stage. So there's almost, for you as the shareholders on the outside, you get to choose at what level you can get exposure at PLC level, at a fund level, or at a deal by deal basis. I think also us being close to the companies gives us early exposure to risk. We can see the problem early on, and it enables us to take mitigation measures, either to help the company avoid the problem or to protect ourselves as an investor. So look, I don't have a McKinsey style risk management 60-page glossy report, but in a very practical way, we have this multifaceted risk management approach to our portfolio, where we feel we have some advantages to others. Question from James. When do we expect to see the next result from the ongoing Glycotest US clinical trial? So James, excellent question, and a natural one. Glycotest represents a significant part of our fair value. So Glycotest, as I've talked previously, they have completed the collection of their data. We have we're the proud owners of what we believe is one of the world's largest liver cancer tissue blood bank in the world. That in itself is a significant asset. What they're doing now is they're running their assays through the mass spec platform with Georgia Tech University, and subject to funding, we could be seeing readouts within this year. Again, I'll just emphasize that aspect, subject to funding, and there's various things ongoing in terms of us and Glycotest management closing off the fundraise. The reason I emphasize this is that these are difficult markets. We can help the company continue kind of the steady ship. It's that big next jump that we need that's subject to funding. We're quite optimistic around it, and upon closing that, it's less than a year. It's in the order of many months, but less than a year that they need to complete that program. And finally, there's a pre-submitted question around a valuation methodology. What is it, and do we have confidence in these valuations? So I'm the ever-optimistic CEO and entrepreneur, so maybe I'll hand over to my general counsel to give his view on the valuation methodology we use.
Yeah, sure. Thanks, Ilian. So the core to this is we follow the BVCA guidelines on how to value our portfolio. This primarily looks at it's a reverse-looking methodology, so it primarily looks at the last funding rounds for each of the companies, and we take fair value based upon that. In terms of that's the methodology. In terms of our confidence levels, Ilian illustrated it very well, I think. So first and foremost, this is all subject to audit. So we're in that sense, we're very confident on the valuations. Referring back to one of his earlier slides, so I think we see upside upon those valuations. So we're as an optimist myself, I think we're really looking at the valuations as the baseline here, because they're reverse looking. So in the meantime, since the company's last fundraising, generally with our companies being in the high growth space, continue their high growth, we're expecting them to grow rather than reduce. So we're expecting values to go up rather than to go down. And we're looking at things that haven't been incorporated in the valuation methodology from the BVCA. So things like that growth that I've mentioned between a fundraising and current date, things like carried interest, things like goodwill in our own business, and the fact that we're revenue generating in our own right. All of those things aren't incorporated into the valuations and the fair values that you've seen in the financial slides. So We have a great deal of confidence, and we think there's hidden value, which has been commented on by other financial commentators in the market.
Thanks, Ed. And a question from James K. Our investment in deep tech recycling looks incredibly exciting. Can you expand on the pilot plant, MOU, and which countries are involved? And James, I also agree. It's a really exciting business, and as you know, I've had long-term exposure to the deep tech recycling story, including the predecessor company from which we acquired the asset, or from their administrators. I mean, first of all, I would say this is the right time for plastic chemical recycling. You know, the concept has been around for a long time. Now we can see, both on a regulatory and commercial basis, the recognition that this is the way. And what we've seen with the deep tech recycling team is that they're having a lot of interest, inbound interest from real users, you know, real players. It's not the I don't mean this in a disparaging way, but it's not the ESG department of a big corporate. Let's spend a bit of money to see it. These are real players, mid-market companies in Europe that are looking at, actually, we need a solution now because there's a specific regulatory framework coming in. So the first thing I want to emphasize with deep tech is that they have a pipeline of opportunities. They've learned from the past. So there is a diversification of opportunities. And at any point in time, one plant opportunity accelerates, another one slows down. A few months later, the other one has a breakthrough. So they're not dependent on any one opportunity. The Scandinavian opportunity in particular is very interesting. I don't want to mention the country because it will put the management team in an uncomfortable position. We're in the middle of negotiations there on the go forward. But essentially, this would see a full commercial plant operating off balance sheet for deep tech. It's an SPV that's formed in that jurisdiction, and the SPV has been formed between deep tech and the other two partners, funded at the SPV level, not by deep tech recycling, but by third parties there. Deep tech recycling itself is looking to contribute the mothballed assets that we acquired. So there is a crystallization of assets through that in the many millions. From the partner's perspective, they also win because it accelerates the project. It will take more than a year, possibly 2 years, to build out that equipment, and it's there. It's ready to move forward. Having said that, look, it's project finance. It's in a complex space, so these things naturally take time to negotiate, build out, and develop. And in the same time, we're building out several other opportunities in parallel. We're quite optimistic. I'll say one more thing about deep tech recycling. If you look at companies such as Agilix, let's say, which are listed on the Oslo Stock Exchange, you can see the valuation uplift that having one operating plant gives you. And deep tech recycling has a route to more than one plants with the current pipeline. So we expect significant value uplift from where we are right now once a plant has been launched, and the potential for M&A at that point. There's two more questions. One is around shareholder value and strategy from Stefan. What strategy do you plan to employ to ensure shareholder value is reflected in the share price? Well, I mean, a lot of it is what we're doing right now, just having a very streetwise, real discussion about, look, this is what this business is. You know, we could fill it with jargon, but bottom line is it's people doing work with real companies doing real things. I think there's an element here that perhaps we need to get better and more frequent at communicating with the market what is happening. It's like some of the really significant developments don't meet the technical criteria for an RNS. So it's making more use of periodic statements and LinkedIn. Ultimately, we know that the market ultimately wants us to do one cycle, to have an exit, to show that the whole cycle works. I would say with the expanded portfolio, including the Martlet Capital portfolio, the opportunities for exits are increasing continuously. And at the same time, we are focused on also maximizing value. We don't want to just have an exit for the sake of it, because then you won't be happy that we sold it for a lower, lower price. But it's on these different levels. And there's a question by Chris. Given the large discount to NAV to value, do you have any concerns with regards to a takeover of EMV? Very good question. Look, we're a publicly listed company, and the rules are the rules. From our perspective, we are focused on on delivering on our strategy and implementing it well. For the rest of it, I think we have a strong standalone strategy for us to execute. I would flip it the other way, that a realignment of our value with our share price perhaps makes it easier for us to do interesting things on the market, and that's certainly something that hasn't escaped our attention.
I'd probably just add to that, Ilian, that looking at our shareholder capital table, as we had in our earlier slides, the pie chart, that there's a diverse holding, but the management team has around 17%. There are other large shareholders, so clearly any kind of takeover offer would require people to be on board with it, and that could be a good thing as well as a concerning thing. So obviously it all depends upon the price that we're to be tabled. But anyway, all very hypothetical, but hopefully not a concern. We're certainly not concerned.
Thank you, Ed. Okay, well, I think maybe with that we will conclude. I appreciate your patience. We're just a few minutes over our limit. Thank you for your support. Again, these slides will be both live on IMC and on our website. Please continue to engage with us. For regulatory reasons, we can't always respond in a very public manner, but we do listen. We do read. We want to know what you think about. Ultimately, you are our shareholders, and hang on for the rest of the story to unfold.
Ilian, Ed, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of EMV Capital PLC, we'd like to thank you for attending today's presentation, and good morning to you all.